Hello, welcome to BQ Prime. You're watching a special talking point with Jugeshinder Singh or Robbie Singh, who's the Group CFO of Adani Group. Uh, we saw a report coming out with a US research firm, Hindenburg Research, and there were certain issues which were raised in that report. And Robbie is here with us today to clarify and give the right perspective of what have been asserted in that report. Robbie, let me begin with the share price first. In the last 2 days, we have seen a lot of hammering of the share price, mostly speculative in nature. The price has gone below the IPO price band. The intention of the IPO was to bring in retail investors, expand the pool. How do you plan to bring back the retail investors?
So there are two aspects to this. One on the share prices. That one was we wanted to just expand. As I said, objective was to expand the share register. A retail investor was a specific target we have because we are in the assets of India. So core assets of India must be owned by Indian people also. So that was the objective of the retail. And the second aspect was to build the coverage and improve the liquidity in the stock. So the first two will happen. Institutions will come in. Now because retail investor, people, is somebody 2 lakh rupees, so they will 80 shares or 100 shares. Now they can get that on the market also, price is below. So for them, you have this logical conundrum as to what to do. So we will, depending on, because we are going ahead with the FPO, we'll see the institutional participation. So we don't know what final shape will take place. And what could be the final position, but there could be some reduced participation by retail, but that's okay. I mean, this is a long-term plan for us. We want to end up in a situation 10 years, 20 years, 30 years from now, where the very significant retail ownership of Indian assets, which we will achieve. So it's not short term, it's a start. We are at the starting line, and it's a marathon. And when we end it, then by that time, I am very confident that in Indian retail, Indian core assets of infra, airports, roads, power stations, transmission lines, brands like Fortune, Ambuja, ACC will be owned by Indians. This I'm confident of, and retail participation will be good. So that journey I'm confident of, and we are confident because it is demonstrated by hardcore analysts who do their own work, are institutional long investors, that despite the price volatility, they are staying with the transaction. And that just shows to you the underlying value people are ascribing. That is, they are ignoring even the extreme volatility of the other day. And they are saying, no, we are still in. So that shows you what the professional long investors are thinking.
I get that. I know the institutions have come in a good number for your anchor book. You raised nearly 6,000 odd crores from the anchor book itself. In the last few days, as the volatility was there, have you been interacting with the anchor book participants? What is their viewpoint in it? I'm assuming that because of the lock-in period, they're not worried much, but they still be having some questions and feedbacks which will be coming in. So what's coming in from there?
Universally, the feedback is, please go ahead. This is not an issue.
Okay. And have you got any kind of confidence coming from the domestic financial institutions, mutual funds? Because we had some of the life insurance companies like SBI and HDFC also participating in your anchor book. But what about mutual funds and others? Are they also giving you the same kind of confidence?
Yeah, domestic mutual funds historically haven't been a big participant in infra. So we have few, like in Ambuja SEC now, and Ports, and also Wilmar, and in this one was private mutual funds, then SBI mutual fund, etc. are there in the anchor book, which is made public. There are some mutual funds who because of infra is long period, we don't have any 2, 3, 5 year horizon assets. We are just long term. So we are more in our infra platform more suited to insurance and life companies. So we are less attractive to a mutual fund because we have no 3 year, 2 year horizon assets. So that's market we ourselves have not chased either. We are more interested in real long-term wealth creation. because we'll eventually core infra utility will pay dividends, etc. So it's more suited to life companies, more suited to insurance companies, because they start soon are all the companies are paying small dividends now, and they'll start making big dividends as we go through. Come 2026, dividends will rise. Come 30, dividends will rise more. So it's a profile that is catching up, and so it suits particular type of investor. And so we have, from the investors that we find mutual interest, strategic interest, massive level of interest, and massive support.
Do you see the entire FPO going through demand enough to to fully subscribe to the 20,000 crores that you're planning to raise, and maybe oversubscribe as well, as the demand you're saying is very high?
Yeah, the FPO will be subscribed fully because the institutional demand itself is high. And what would be the final subscription, we will know in 2 days' time.
Okay. My second question will be with respect to the legal recourse, because you came out with a statement that you are exploring legal recourse against the Hindenburg research for the kind of assertions they have made and allegations they have made both in India and the US. And the US-based firm has come back and challenged you to file a suit in the US. What is your take on that?
See, that we don't want to get into that issue. We are evaluating legal options. Okay. Now, what we have published on Sunday clearly established either deliberate misrepresentation or willfully, with knowledge, misrepresenting facts. I'll give you an example. They claim that we did round tripping, and they give an example, $1 billion on a transaction with Adani Power. Now, if somebody claims to do research, they would know clearly that Adani Power bought an asset from IBC. Yeah. The original loans were given to SR Mahan, not to us. Yeah. Now, then committee of creditors approved. We were the L1 bidders. That's great. Maximum recovery of bad loans happened via our bid. So, okay, we gave the maximum recovery to Indian banks. Then NCLT approved the whole thing, court. The resolution professional was a big 6 accounting firm. In that process, something comes up which is called a non-sustainable debt, which has zero value. So there was a $1 billion ECB loan, which the creditor committee, they themselves determined that this has no value, zero value. So in the settlement process, we had to acquire the whole thing. Now, Adani Power is a domestic company. It can't get into business of acquiring ECB loans. So what we did was, in our disclosed only, overseas disclosed structure, we said, okay, it's zero value. So that company paid $100 to acquire that $1 billion zero value loan. So what Hindenburg did was, they would know all this because they have done 2 years of research. They declined, they deliberately kept the NCLT order hidden. They deliberately kept the process of IBC hidden. And they simply reported one side, because now that you own that $1 billion loan, you'll report it's 1 billion. Yeah, its value is zero. You own that loan. So it's reported in there. So they say, no, tell us the source of this 1 billion. Now they have done the research. They know the loan was actually given to SR Mahan, not to us. So they deliberately misled and said this is round tripping. Their report is full of 68 of their 88 questions are full of such misrepresentations. Deliberate. I'm saying deliberate because if you've done 2 years of research, you would find this. The second aspect of this is, actually, you go, how did they find this in the first place? Did they do any forensics? Did they have to go through 10 accountings and then figure it out? No, actually, we disclosed ourselves. Because it's an NCLT thing, so we reported ourselves. So our own disclosure. So 68 of these things are Adani entities disclosures. What they've done is they've taken the disclosures. Our disclosure is full. It goes through all of this that I've discussed with you. They've deliberately kept away 90% of it, report just 10% to create misleading effect. Now their bogus, misleading, misrepresenting report has caused a loss to domestic investor base. The first thing our legal team's evaluating, they'll evaluate and see what happens. If they have to face justice, they have to face justice in India first. They must answer to our people and our justice system. How then that gets enforced? Because they are sitting in a WeWork desk in New York. They can simply disappear tomorrow. We don't know. But first, they must face justice in India. If that is the conclusion of our legal team. Because that we have shared our report with our legal team also. It's on SEBI also. Regulator might also want to chase after this. Because they'll also find out all of this. They'll see our report now. They'll peruse our report. We've given it to BSE. We've given it to NSE. We're also going to hand it to the relevant ministries also in India. It's for us is public. Yeah. So we have nothing to hide. So we will prove unquestionably with documentary. That's why our report goes into 400 pages. Because it attaches all the relevant documents also. And we have taken additional step also. That is, we have compiled this report, made it public, and we have handed all of this data, documents, and report to a third party also. And they will keep it also. So it's not just us saying, oh, I have the document and there's the photocopy of it. We've actually handed over that material also. And therefore, a third party leading global firm will keep it. And they will all, so this is now matter that will be assessed legally as to how it happens. And people must face justice in India first. Because that's here where they have caused maximum damage.
Robbie, one of the assertions made is the valuation of the 7 listed companies. They claim that it has 85% downside. It's overvalued. How do you, say about this assertion that the valuation part, which they are talking that there is a 85% downside to it.
Okay, let's assume that, for the time being, the best way to do that is, in physics and mathematics, we just do a logical test. So let's assume first they are correct. Our value was approximately, on a given date, about $220 billion. So they are saying value is 85% over. Okay, so they are saying the value should be 40 billion. Or just about 50 billion. Maximum. Our EBITDA is 8 billion. So they are saying we should trade at 6 times.
Yeah.
Okay. What does in a market that is growing, business that is growing 22% a year? That's evidence last 9 years we have grown 22% to 23%. So they are saying an infrastructure business, utility business, which has majority is contractual. That business should be trading at 6 times. When even in an OECD market like US or Europe or Australia, infra business trades at over 20 times, some of them. Okay, now, and they grow at between 2 to 5% because they matured. So let's assume that we trade at their multiples, EV, EBITDA, 15 times, 20 times. If we're trading at 20, we should be 160 times here. And we are growing 22%, they grow 5%. So you adjust our growth. You give us some value for our growth, extra 18% growth a year. Extra 18% growth a year means $1.6 billion growing at 18%. Okay, so let's say 1.6 also trades at 20. Okay, that means another 32. If we trade exactly like them, yeah, then we should be minimum as it is 200 billion. Now, yeah. So where is this 85% number? Okay, you can do this mathematics for grade 5 student and they will know that this is rubbish. So what they've done is they just wanted to, they realize that nobody will pay attention, that like nobody will say, okay, let me investigate where this billion came from and click on the NCLT quote and find out. Okay, they relied on this, that their misrepresentation will not be verified and the media will run with this. And they were correct in that. In India, a report which is full of misrepresentations ran. Yeah. And nobody questioned. Nobody said, let me check one thing. Okay, I gave you one example. I can give you another example. They say we overinflated numbers. That also, they didn't find it out. We disclosed. And in fact, they said one side only. We have already taken because I'm CFO of AEL also. We've taken the write down in AEL. We put it to loss through the P&L of AEL already. They didn't tell that because it's in the same note that they've taken from our own disclosure. So they only gave one side of it to create sensationalism that we understate revenue. Okay. So they've all of this, like then said diamond trading case, why have you got X person working for you? Because they were in the diamond trading case. What diamond trading case have been ruled by the regional director of customs, then the High Court of Gujarat. Okay. So now the person, they said no case to answer. It's all bogus, this whole thing, investigation. Now they are saying, please tell, if they want to ask a question, they can go to High Court and say, no, we want to file against you. Go to Supreme Court. There's no question for us. So they've done this kind of thing to create. And so then in the middle, they threw this valuation thing. Okay, if you don't believe in our report, of course, they themselves know that it's all misrepresented thing. That valuation aspect. Okay. The valuation aspect is just logically flawed. Okay. You can disagree that, it should not be 20, it should be 22. I can say it should be 25 because we are growing fast. I can say it should be 30 because we are growing really fast, 22%. Somebody can say, no, I don't believe in 30. My risk means I need to be at I need to earn a minimum of 15%. I say, no, you should earn 13%. So you can have this debate of what actual will be on your expected rate of return on a particular asset. We understand that. But that would be a difference. Somebody will say, I want 15% minimum return. Somebody say, I am okay with 12. Okay, I might say being in India, having Indian heritage and growing up in India, went to school, college in India. I would say I'm happy with 10% return. I'm sitting here only. So that can be there, but that's a variation in your expectation. You cannot fundamentally say that the world over, core infra utilities can trade at 20x EV EBITDA, but for Adani Group it should only be 6. And what is this? I mean, we can laugh at it. It's like a joke, but it has caused damage to minority shareholders and criminal damage to them. So if now their legal team determines that case has to be answered, then they must face justice in India.
Cool. The another thing which has been talked about is the debt levels of the group. Too much has been written about. You have clarified many times that it's across various businesses and not and well funded for. But just to bring it back on the table, the debt issue. While you have given us a timeline in the earlier interview about debt to EBITDA level that you're looking for each of the businesses, on a gross or net debt level, is there a time for you to say that, okay, by this year we'll be net debt zero?
No, net debt zero for infra business would be a problem. Because see, infra, we are a service provider, non-discretionary to consumer. Now let's imagine a case. You are a rickshawala. Okay. Now let's, for example, we have a person who supports my mother's house in Patiala. Okay. Now they also have electricity at their house. How do you determine the price of electricity? It's the rate of return on asset. Now let's say you have no debt, now 100% equity. Now equity rate is higher than debt. So means that charge has to go up. Are we in a position to charge more to our public? So infra capital has to be a judicious mix so we can keep tariffs low. And in India, it's particularly important we keep tariffs low so that all people have access to good quality infrastructure. If somebody wants to afford having proper electricity and gas connections, they should be able to afford. It should not be prohibitively expensive. If we make everything equity, it will become expensive. So certain debt has to be there in the mix so that you can keep the cost of capital, overall cost of capital, low. Now, how do you determine what is valid amount of debt? Then that becomes the question. Now there it is basically we look at how much cash we produce, and that determines how much debt we can have. So our objective there is very simple, that we should comfortably have the debt amount that will give us the same credit rating as Government of India. Okay, so if you look at Adani Ports, Adani Transmission, parts of Adani Green, they have the same credit rating as Government of India. Okay, meaning that they have the same credit risk. Now, beyond that, that's the highest we can achieve to be the same as your country domicile. So all our business already are at that level. If we reduce debt any further, then by default, tariffs for consumers will rise, because we'll still have to make the return on equity. That is not a good thing to do. In fact, 6 of our businesses are regulated also. Not only we have to file accounts in the stock exchange, we have to file our numbers with the regulator also, under Electricity Act, under PNG-RB Act, under ERA, airports. So when we file, regulator says to us, I will only give you weighted average return of X%. Now, equity is higher than that. So regulator themselves say that you must have some prudent level of debt. Because otherwise, question will come to them that you increase the tariffs on people. So so the target we set is that our debt metrics should be similar as if we were same credit quality that like Government of India. And so we start from there. And then whatever we have to do in the amount of debt, how we set it up. So for example, in infrastructure, transmission asset, 35 years, 60 years. You can't have 3-year debt also. So you have a 30-year debt. So now we have to pay a little bit more for it. So we have 30-year debt. But what it means is we don't have to refinance it. We don't have to, rate doesn't change. So it can be a slowly pay it off in 30 years. But what it does is average life now becomes 17 years. Now people will say, oh, you'll pay debt in 17 years. How is it? Oh, but that is a good thing, because it is called duration matching. If we don't match the duration risk, we will create a huge level of asset liability mismatch. And unfortunately, that's what happened to ILFS. Long assets and short-term debt. So they could say, oh, we'll pay this off, but paying off, something wrong happens, you are stuck. So you cannot create that level of duration mismatch that you add financial risk to a very good utility business.
The other thing which which has been talked about is about the some of the offshore funds which hold a large stake in Adani Group companies, which are one of the allegations which they have put out is about the relationships which Adani Group has with those funds. Do you have any relationship or linkages with those offshore funds listed in who are invested in the Adani Group companies, and the portfolio has large amounts of Adani shares as compared to the other companies?
The short answer to that is no, I don't, because from my vantage point, all the family holdings are fully disclosed. We did wholesale open offer. Our overseas structure is fully disclosed. Our domestic structure is fully disclosed already. Everything is with SEBI, fully disclosed. Okay, so the short answer is no. But as a prudent thing, you go, okay, let me check also. So I'll give you a simple example. A fund that they mentioned. So I asked my team to go through and say, we have what we because we wanted to respond to each question. So let's say that fund, we found out, originally invested 24 crores in AEL. In AEL alone, that 24 crore, which is approximately $3 million, $3 million they invested. that is now equal to 400 million. Yeah. Plus on the way, because they invested in 2012, 2013, they got APSCZ shares, transmission shares, green shares. So their value has now, it's like worth X billion. So it's not that they invested X billion. They only invested $3 million. Okay. Now, if you as an individual, say for example, Sajid, it was you. Now you have 4 billion of Adani shares, and somebody will come to me and says, I looked at Sajid's portfolio. Sajid owns 4 billion of Adani share, and it is 99.99% of his net worth. Now they are right also, but it's not that you have done anything wrong. So now if somebody says to me, no, go tell Sajid, sell your shares. Yeah. Or better still, no, it's not Sajid who owns it. It's you. Otherwise, how can somebody own 99% of their net worth with you? So this is not logic. It doesn't make sense from a company executive point of view. We look at share registers. Our objective is to continue to expand our share register, which is why we're doing this FPO, which is why we did primary placement with IHC last year. So that we continue to do.
So the high concentration in this funds is primarily because of the shareholder unlocking value unlock that happened over a period of last maybe 10 years. That's the reason.
I gave you one example. I went through this, and it would be broadly true if So like I said, it's not that they had concentration in their fund or whatever it is. It is just that it could very well be an individual made a decision to invest $3 million. Okay. Now it's end up at 99% of their wealth because of what happened to underlying businesses. It's not that they had 6 billion of cash or 4 billion of cash and they all invested in Adani. They only invested $3 million.
Point taken. The other thing which which they've been talking about is the alleged accounting irregularities and lack of financial controls, including in the inexperienced audit firm that is there in the group. And how I respond to that? I know in one of your responses you said that you're contemplating changing that to Big Six, but this is what they're alleging.
See, that is also it's quite bizarre, that allegation, because what they say is against selective misrepresentation. Because they are talking about auditor of Adani Enterprise. But Adani Enterprise is an incubator. Adani Enterprise is just some of its businesses underneath. Okay, at the top we are summing. So now who should be the auditor and how we design the auditor is who is the auditor of Mile Airport? Big Six. Who is the auditor of a mining business? Big Six. And like this, in the underlying businesses, they're Big Six auditors. That's number one. Number two, we do have an obligation as a large corporate in India to develop local vendors also. Okay, for example, Airport Authority of India insists that in their airport that they give us a concession, which we are concession holder. In the concession, they have a requirement that our auditor has to be one from their panel. We can have a joint auditor, somebody else, but auditor should be from their panel. They are doing the same thing as we are doing. Airport Authority of India is developing local vendors. Okay. Now, if Airport Authority of India is part of our concession of owning an airport, is a requirement of the concession agreement. So what should we do? Breach the concession? Because somebody in New York sitting in WeWork office doesn't like it? It's incorrect. Secondly, there is an irony also here. They are saying this firm is small. Okay.
The age of the audit partner is 20 to 29.
That's okay. But the firm is small, this. Wait, how big is the firm making the acquisition? They don't even have a formal office. They sit in WeWork desk. So this is the irony of it. Secondly, How old was Bill Gates in 1985 when he set up Microsoft? So is it only that young upcoming talent is only available in one country and not Indians cannot have talent at young age? What is this? Why impugn people like that? What happens if that 25-year-old is a partner of a future very large law firm? When they that's their vision, that's their idea, that's their capacity, that's what they're working hard. They are the future Mark Zuckerberg, or they're a future Elon Musk. I mean, this is not fair. It's very sad that this kind of assertions are made about people that you don't know, people you have never met. It is almost like as if the colonialism hasn't changed. It is really, really troubling and saddening that this kind of thing happens in our country, and we in turn say, yeah, this is a good question. No, this is a painful question. It's an insulting question. It is denigrating a professional who you have never met, never spoken to, don't know. How is it fair?
Point taken. The other one, with respect to financials, is the frequent churn in CFOs in the Adani Group. They claim that the Adani Group has not been able to retain senior financial managers, and so they're claiming that there is issue with the financials. That's why the CFOs are so high. Churn is so high.
That's why I said the whole report is a litany of misrepresentations, Sajid. So first is I am here for past 11 years myself. Okay, that's one thing. Okay, we'll now put that aside. Now I'll give you an example of a churn. Kaushal Shah was CFO of Adani Transmission. Yeah, Adani Transmission growing, and we needed. He's a veteran of the group, 10-15 years. And in the growth phase, you go to the site. It's very intense. So Adani Transmission stabilized, became investment grade rated, acquired Mumbai Distribution, became Adani Transmission and Distribution. The business stabilized, become a normal utility. In the meantime, Adani Green was growing fast. Yeah. So Adani Green had a CFO who wanted to do other things. Yeah. So we moved Kaushal to Adani Green. So they say Adani Transmission CFO changed, but he's still in Adani portfolio company only. He's now CFO of Adani Green. Adani Green went through growth phase, stabilized. Now it is about 7 gigawatt of operating assets, 7,000. Yeah, it's stable, growing. So we got a new CFO professional. He joins Adani Green, but in the meantime we have to build the green hydrogen business. So we move Kaushal to green hydrogen. Now they say there's a churn in Adani Green, but Kaushal is still there. Okay. Now Adani Green, Total is a 20% investor. In Adani new hydrogen business, Total will be a 25% investor. Kaushal is dealt with Total, our partner. He will have to deal with our partner there also. So for us, this is a progression of the group. It shows the ability of the group to develop talent. Okay. I can give you examples like this in other places also. Devang was group CFO, now he heads up the domestic family office. So it's not that people have left, they are still there. Okay. Similarly, Amit Desai was group CFO. He went to do his own things. He went and did his own thing for 3 years, 4 years. Now he's independent director at one of our companies. Do you think he will be, because he doesn't believe in financial, he'll become independent director? So he's there. So this is a progression of a growing group. Okay. So rather than look at it in this manner, I gave you the examples. I can keep giving you these examples. And now I can give you another example. We had MSPVL CFO. They did a very good job. We said now we bought the distribution business, stabilize it in Mumbai. So he went there. From there, bad business got stabilized. We have to build another business airport. So we brought him into the airport. Now people say that business CFO churn. No. Now that person is still in Adani only at airports, head of finance. Now in Mumbai distribution, we moved the head of treasury from APSEZ to our port business to Mumbai distribution business. And we bring a new treasurer capable person in Adani ports. Now say the Adani port is churning. No, it is the how you build organizational development over a longer period of time. We need to create bench strength. We need to move people. We need to grow people. We need to get their careers. If you become a CFO, then let's say you're a finance professional. Now, what is the next position for you? You're stuck. So do they expect person to be stuck for 20 years or 15 years? You're a CFO now. Naturally, you want to grow and continue to develop. And it's our obligation to them, obligation to our staff to develop them. And to call this a churn is madness. Now, natural churn happens because our nature of businesses are changing also. Okay, for in Adani Enterprise, for example, okay, Adani Enterprise has technically 5 CFOs in the last 15 years. Anyway, the average term is still 3. But there were 2 churns very quickly because we were going through a change period. Okay, and largely because to onboard me as a CFO took 1 year. So in the interim, there was a CFO. Okay, if straight away just give me the title, then in 15 years we'd have 4. Now no churn. See, this is not this is lack of understanding of organizational development and risk management of an organizational development plan. Do they expect that we should have no onboarding periods? And if that means temporarily tomorrow, let's say in one of our established companies, a CFO has to retire. Now, and I put another person who is head of finance in Adani Enterprise business, which is incubating business, and say you please be the CFO of that public company. Because public company we can't leave till we onboard the new person who's also there. Now we are onboarding them. Okay, now they say there's a churn. No, it is organization planning and development that happens in a certain way. Okay, we have that organization development planning for all levels. N-1 in my case, N-1, N-2, N-3. I can go through the individual development plans with you of 160 of my top executives personally by name, how the IDP will develop in 1 year, how we see them in 3 years, how we see them in 5 years, how we see them in 10 years. It is my duty as a leader of finance function to ensure that our people develop.
Is there an issue with respect to communicating that effectively to the market or across to stakeholders? I'm just asking that question.
It has not come from our and that answer to that is yes, actually, because non-financial stakeholders, we have to convey this. Actually, this question doesn't come from our banking partners or investors, because investors who are invested in Green, Adani Green or Adani Transmission, when they see Kaushal, they know he was in Adani Transmission. So they never ask the question. They know there's no churn. Okay, when they see Adani Enterprise team now, and we have to talk about green hydrogen, they see Kaushal, they say, oh, okay, they understand this. So the investor community, the banking community, the rating community, they understand this churn is normal for a business of our size. But you are right. And that is why we have formally upgraded our COPCOM, we have formally upgraded our department so that we are able to have these interactions in a more consistent manner and convey our non-financial stakeholders also appropriate information so that this gap and understanding doesn't emerge. So that we are improving. And we have taken that feedback over the last 3 years and we are continually trying to improve.
Another thing which has been raised by the report and is the related party transactions which has been there. You mentioned that many of them are part of the Adani portfolio presentation of 2015. But just to put things in perspective, does any of the related party transaction that you mentioned at that point in time with private promoter companies, how many of them is continuing, and whether you have all those approved by the shareholders or not, as per SEBI requirement?
See, the first thing is that actually they did not pick up these related party transactions. We disclosed them.
Yeah.
So when we have disclosed them, we've disclosed because we follow certain standard, and they were appropriately disclosed. So it's in our disclosure document. So they haven't found this out. That's the first thing I would like to clear that. Now, the related party, some related party transactions are continuing in nature, some are not continuing in nature. Some happen at a time and we disclose as per our related party policies, which are laid down very clearly for the boards, and they go to the independent committee or sub part of the audit committee, and it is reviewed by independent directors, and it happens that way. There are thresholds, there are limits, there are checks and balances. If there is transaction of a certain size and above, it could even go to vote of the majority of the minority investors also. Okay, so there's a full policy structure. That's number one. Number two, as a large group, for example, we run our entire utility platform on a cloud business called an Energy Nerve Operating Center. So now naturally, AIMSL, which operates this thing, will become a related party to every business, green, transmission, power, every utility business. That is our strength. It is on the third page of our presentation, our strength in operations. Now imagine if you have to build a cloud business and cloud architecture in each business individually. You will never build it. That's why it is unique model. Even when people come from overseas and say they see this, which is here on the 4th floor in our head office, we invite people to, actually that's a showcase presentation for us. In fact, two of the rating agencies asked us that what happens if tomorrow you don't do business with AIMSL? The third party operator has to help you. Your cost will go up. It's a negative. That it's so they think of this way, that this is a massive benefit you have. So they misrepresented the whole thing, what it is. Now even in that business also, say for example, Google is our partner in cloud. It is a deep business. It is a business we are very proud of. It is a business that we can today say we are one of the most advanced cloud nerve operating centers of utility in the world. And that they are saying that somehow AMSL payment is a related party. First, we disclose it. Second, it goes through proper procedure. Third, it's not only disclosed just for the purpose of disclosure. It actually is in our offering circulars, which are legal disclosure, which are subject to accounting comfort letter, which are subject to legal sign-offs, which are subject to independent credit assessments. So many assessments. Every investor knows this. Every investor says this is your strength. So what are they claiming actually? What they are showing is not properly understanding and hiding from the people that what this is, what AIMSL is. Now they have done the research for 2 years. They should have all this knowledge. So I'm assuming they have it. So they are deliberately misleading. Or this research wasn't done by them. They got and they put their name and they put it out in the market because they have taken short positions. Now that's fine. That's in the US it's allowed. You do it, okay. But these are the kind of related party transaction, which first our disclosure, second our detailed disclosures, third it's the core part of how we do business. Everybody in the world knows, whoever invests with us, every investor, and they think it's a strength. So what's the question here? A question comes because if you just simply say related party with AIMSL, it's private, you are paying money on the private side. So that is but if you put the whole context, we are told that you must use them, you should use them, and it's your strength. We want to see it. People come and visit it every time. So this is the nature of what they've done. Sujit.
Ravi, this debt issue, this entire report, does it in any way change the kind of timelines that you set yourself out in 2015-16? You've been aggressive on the inorganic front. Does it top you in any way, or your target remains the same and you planning to achieve that irrespective of what these noise is creating in and around Adani companies?
See, even a bogus report like this, which is full of misrepresentations, they could not find anything to even misrepresent actually at our asset performance. So now port will continue to grow, transmission will continue to grow, green will continue to grow, Adani Total Gas will continue to grow, Wilmar will continue to grow, airports will continue to grow. That business is that generate enough cash to do it themselves. So that will continue. What we have to learn something though. So we in the finance function, we have one thing that we always do, which is like you simulate an event risk. Okay, we run this simulation. What happens if an event happens somewhere which is massively disruptive? How will it, and it impacts us? So how will we deal with it? So for example, so we did this impact assessment. So we calculate what will the liquidity requirements, cash requirement, this we must hold in case of an event risk. And it happened actually. COVID happened, which we did not know it will be COVID, but then COVID happened. There was an event risk. We went through that. Then COVID barely finished. Then Russia and Europe decided they want to start fighting. And with that, war started. Then that causes inflation, cost of funds, cost of fuel, cost of construction, everything goes up. Well, then barely that settled a little bit and looked like maybe we'll reach a conclusion. Then specific event related to us, this
Did you factor in this kind of event?
Not this kind of, we factor an event risk, what we call disruption event. And we plan. So we have full planning, but now each event teaches us a lesson also. So COVID, we learned certain things and we build that into our feedback loop, improve our risk response structure. Ukraine war gave us some of the feedback which we did not imagine. That, for example, Afghanistan war happened, nobody in the world got disturbed. Then little war happens in Europe's border, the whole world turned upside down. So we learned that, okay, if the war is in particular place, so we have to define the event also. If a war level event happens, if it happens in Europe, Europe will disturb the whole world. If it happens in Afghanistan, nobody will know. So it allows us to now calibrate our event risk assessments. So we can calibrate if even a war event happens, depending upon which country and continent it happens, it will cause a different level of impact on us. Similarly, this also teaches us something. That, for example, we focus a lot on running good businesses, operating them properly, developing them properly, making high cash profit. But now we have very large equity exposure also, trading exposure also. So something happens to our equity book from a shareholder level. We have to see, okay, with that also we need to keep intelligence, who's trading, how is the trading happening, what's going on, who's asking questions, how we build that, how we understand where somebody is doing something research, how we understand market intelligence. So we will now incorporate that into our risk models.
Does it also bring in a sense of, okay, let's bring in little more equity and have some more dry powder within the group with respect to cash, and that too through some of the businesses that you already mentioned, like airports, we're looking at some strategic partner or some other business which we're looking for partners. Will that expedite the entire process?
No, that doesn't expedite that. We have to do that actually for business needs. We can't do it for our needs, because then you confuse two things. So that business need work will continue. That part of this process was FPO was that only. So that is why the sabotage of the FPO is quite ironic. It actually is doing that. So we will continue to work on that and continue to do that. When we do the full risk assessment of this event, so that we can prepare a risk response model properly, very likely there are a lot of impacts, like there's liquidity. We will see what it has on liquidity levels. We will see what it has on perception. We'll see how it disturbs certain type of investors more than others. For example, there are Title 8 investors. What happens to them in this kind of event? So all that feedback now we'll have much more knowledge, actual event feedback. We'll build those into our risk response models. And if the result is that it means that at company levels we have enough cash liquidity wise, okay, because that's a formula already. If that means that even at shareholder level we are net lenders in terms of our borrowings are less than our loans we have given out, then, but if it means that not only do we need to net lender, we should also be net cash position also should be of a certain level. That will come in our full review. We will complete it very quickly. In COVID period, it took us to complete the risk review by June of that year. After March lockdown, by June we had done the review, and it required some changes. We made those changes. And after the Ukraine war, it took us, like when the war started, we completed our risk reviews by April, and that's why we could do the wholesale transaction. Otherwise, we would have been stuck. PQ had done that. So this will complete by March, and whatever then the risk response changes will be made internally for sure. And every event like this is learning, and we have to continue to remain on the learning aspects. We cannot say, because I was upset by something and I don't want to learn also from it. No, we have to learn and grow, and most certainly on the risk response matrix, there will be some changes after this.
Finally, Robbie, have you approached this regulator and the stock exchanges to conduct an investigation into this sale that happened of shares? Because from the delivery of the share, if you see 17.5% delivery that happened on on Friday. It seems like it was more of a speculative nature of shorts that got in the shorts and cover up that happened. Have you sought regulatory investigation into this?
See, we don't, as a company executive, we don't, it's not a domain that we focus on. Our objective is very simple. I laid out very clearly on that day itself, because I know the questions that they raised in the report. I knew that the questions were from our disclosure, and I knew the questions were misrepresentations. So that's why I said in my mirror that it's a malicious, bogus report. So our first objective was to respond. Then we had to do one quick investor call and say, look, we are responding to each question, which we did on Saturday. Our then objective was to put a detailed, point-wise, fully annotated, fully supported by documentation answer, which runs into 400 odd pages. So we issued that on Sunday. Now we've issued that. We have given it to regulators also. Now what regulators want to take action from that, because a report which is full of misrepresentations has caused a loss to investors. That's one matter. The other matter is that report which is full of misrepresentation was circulated without any caveat in the domestic market. Now, who circulated it, on which WhatsApp it circulated around, a report which is full of such blatant misrepresentations, and what action people took, that will, in full sum of time, regulators, I'm sure, will look at who traded, what happened on that report which was circulated, which was without verification. So now but that is a regulator's domain. So our job is we made our full 400-page report public on Sunday. That is the thing that we wanted to do. Now, legal reviews, etc., we will sit down with the legal team. We handed it to our legal team also. Now they will review, they'll go through that. That's a separate process will take place. I'll be part of it. I'll be sitting in that team, but that process will take some time. And what they deem necessary, we have also shared our Sunday report with the relevant ministries also. Okay, because they need to see this also, that with the level of misrepresentation that has gone here, and the relevant parties, we have made public fully in total. So beyond that is not something that I can, neither do we like to, because we are focused on our business only. So neither we like to say, do this investigation, don't do this investigation, what somebody other is doing. See, our objective is, as Gautam Bhai said in one of the interviews, for example, for us, argument's sake, Dhiru Bhai is an icon of India. Okay. So we have huge respect for Rail. We have huge respect for Mukesh and team. Mukesh and team bring credit to India. We are proud of them. So we are of that nature. Our founder is of that nature. I am of that nature. If I ever get a chance to meet Mukesh, people ask me, what will you do? I said, if I meet somebody like him, I will touch his feet and seek his blessings, because that is the nature of who we are. Okay, so we are as a group, we are not sort of, investigate this and do this and do that. We want to focus zero on our business, run it properly and manage it properly.
Robbie, I know I've taken some time of yours. Thank you very much for joining us on BQ Prime today. Thank you.
Thank you.